Today I'm going to talk to you about a client that came to us with a $2 million portfolio whose number one fear were RMDs, required minimum distributions. You see, they want to leave their retirement accounts as an inheritance to their children. They have enough income to cover their expenses. But what they don't want, or what they fear, is as the government mandates distributions from those retirement accounts, they're going to have to pay tax. And that eventually the amount they want to leave to their kids will be much less than they anticipated. So the question that we'll answer today is, as they're paying tax, if they reinvest that RMD, how much will they have to earn on that invested RMD plus the pre-tax balance in order to cover the annual RMD tax? So we're going to answer that today. I'm going to walk you guys through an Excel sheet that I built. And then lastly, I'm going to give some recommendations, some investment recommendation on how the client can achieve that goal in a very conservative manner. So here we see the needs analysis, some notes that we took during the initial meeting with this client. And we do this for all clients. We need to get to know you on a very intimate level. We ask a lot about your finances and your goals. We can see that their primary goal is capital preservation so that they can leave those retirement accounts to their heirs. A couple other notes here. Their primary residence is paid off. They do have a rental. It is a cash flowing. They have Social Security income of $55,000. They have a rental that's producing $10,000. That's net operating income. They have an annual gross total income of $65,000, the addition of those two. So their secondary goal is to reduce their RMD tax if possible. So obviously the lower or less tax they pay as that money is being distributed from those retirement accounts, the more they'll have to invest, and that break even will get smaller. And we'll get to more of that in just a moment. Questions to answer in the next meeting. What is the rate of return we need to achieve for capital preservation after the tax is paid? What portfolio makes the most sense and why? And then they wanted to know if any of whatever recommendations we make, are those FDIC insured? Are they insured? Here's portfolio design and some recommendations that we'll go over later. Let's jump over to the Excel sheet that I built for the client. So this gets a little tricky, but bear with me and I'll have it all make sense in just a moment. Let me find the zoom. Here we go, 150. Hopefully you guys can see. Let's go to 200, and hopefully you can see that. So up here, prior to the RMDs, their Social Security is taxable at 85% based on their income. They have their net rental income of $10,000. So their modified adjusted gross income for the year is $56,750. Now they have a standard deduction. So that's when you're doing your taxes, you can take the standard deduction, which the government gives you, the feds give you, or you can itemize. And usually it's whatever is greater. Itemize is your deductions, all your write-offs. If combined, those are greater than the standard deduction, then you will take that amount. For most people nowadays, because the standard deduction was doubled in 2016, you'll take the standard deduction. In this case, because of their age, it's $26,800 in 2023. So if we subtract those two, their income less their deductions, their taxable income, what's run through these tax tables on the right over here is $29,950. Now I built a little formula that produces this federal tax here. You can see it up at the top. It's just running this taxable income through this bracket here. So 10% from 0 to 19,900. So they're going to have to pay $1,990 on that first $20,000, and then 12% on the next $19,901 to $81,050. In their case, up to $29,000. So $19,901 to $29,000, about $10,000 is subject to 12%. So that totals $3,196. That's what they'll owe the Fed. And then for California, I just use 5% as an average. So we're just taking 5% here from their taxable income, the 29. So their total tax for 2023, this is an estimate, is $4,693. What does that mean? Well, that tells us something. First of all, it gives us their effective tax rate or their federal tax rate. if we take that tax, the federal tax, and we divide it by their taxable income, that tells us the amount of tax they pay on every dollar that they earn. So about 11 cents for every dollar they earn is paid to the federal government. And then it's 5% because I went ahead and assumed 5% for every, or 5 cents for every dollar that they earn. The total tax rate between the Fed and state is 15.67%. For every dollar they earn, they're giving the government about 16 cents. So moving right along to the tables below. Here is their age, starting at 72. They're not 72 yet. If you look at their dates of birth here on the case notes, they're not 72 yet, but we're assuming 72 because that's when RMDs will start, when the government or the feds, they mandate you begin making distributions from your retirement accounts. 72, and I ran that all the way out to 120, and I did that just because I wanted to see if they, in fact, would have capital preservation all the way through. So anyhow, 72 is starting. And there's this life expectancy factor. Now, that's published by the IRS. It's in the publication. And this is a rule that they use and apply to the value of your retirement assets. And if you simply do some division here, it tells us what your RMD is going to be. It's if you divide your total retirement account balances at the end of the year by this factor, this life expectancy factor, that will tell you how much you need to distribute from those retirement accounts, otherwise known as the RMD. Now, I did add the returns here. So, we are assuming 0.72. I'm just going to put 0 for now, and we'll get back to that in a minute so that this makes sense for us. 1.8 million, and what I'll do is I'll pull up a calculator so that you guys can see how this works. That's a calculator. And so all we have to do is take 1,800,000, those are their retirement assets, and divide it by 27.4. And there you go, 65,693. They will need to distribute that amount from their retirement assets in the following year. Now, if we do that from the 1.8 million, the balance is 1.7 million, 34,000 and some change. And that tells us that their RMD as a percentage is 3.79%. So moving right along. So if you were to convert this 27.4 life expectancy factor into a percentage, it's 3.79%. That's how much they had to distribute from their 1.8 million. Now, their modified adjusted gross income plus their RMD is $122,443. Now we are looking, this column here is the addition of their RMD, the 65,000 plus the 56,750 that their tax that they earned that year. I'm going to walk you through the tax return now, including the RMD. So the 65,000, call it 700 RMD distribution plus the, call it $57,000 that they earned between their Social Security benefit and their rental income is now 122,000. So they're earning on an annual basis now $122,443. We already know the standard deduction is $26,800. Let me scoot over a little bit here. So their taxable income now, if you subtract the 122 by the 26,800, their taxable income is 95,000. And if we run that through the tax table up above, so it's the same thing we did earlier, we're running it through this tax table, their federal tax now is 12,500. It was a lot lower before, but it's higher now because their income is almost doubled because of the RMD. So they will have $12,500 owed to the federal and $4,782 to the state that's at 5%, and a total tax now of $17,000 per year. So they went from a total tax of $4,693 up to $17,320. I mean, that's like 3 or 4 times. The total tax rate has jumped too from 15%. I believe we were at 15, almost 16%, to 18%. Their post-tax RMD is $53,000. Now, their post-tax RMD is the amount of RMD that is left after they've paid taxes, after they pay tax on it. This tells us, so the tax paid on the RMD, $12,627. So from the RMD that they had to pull, and we looked at that earlier, it was 65,000. It's back a little further. 65,693. If we apply their effective tax rate to it, it tells us how much tax they paid on it, which was $12,627. In other words, because of the RMD, they now are on the hook for an additional $12,627 per year. If we subtract that $12,627 from the $65,000, it tells us how much they're left with to reinvest. So 65 becomes 53, and we're going to invest that because we want to use that money to grow back what they lost to taxes, to get back what they lost to taxes. If we look at the RMD as a percent of their total assets, the 65,000 in the face of 1.8 million, it's about 0.7%. And the ending value plus reinvested RMD is 1,787,373. If you look here, they're actually, even if they reinvest the money right now, they're not earning a rate of return. So their capital is depleting. In other words, the RMD comes out 65,000. They pay tax on it. Whatever is left goes right back into the $1.8 million account. But since they did not earn a rate of return on the 1.8 million, the remainder of the 1.8 after the 65 is distributed, or the reinvested amount, they're actually depleting their retirement assets. And so we can see that this amount is in fact dropping over time. So the question is, how much do they need to earn on an annual basis in order to keep the to have capital preservation? So to keep the 1.8 million as a steady balance over time. And we figured that out to be 0.72, less than 1%, which is great. So if I just go back here and plug in 0.72, and I won't bother you with the math on that, we can see things change. First of all, their starting value was 1.8, but we added the returns here. So 1.8 million multiplied by the 0.72% is 1,812,000. And the RMD will come from that balance. Now the ending balance here is lower, but bear with me for a minute as we get toward the end here, because that RMD will actually go back into the account. So ending value after we take the RMD is 1.74, but that 65,000 here we'll pay tax on. Down here, tax on the RMD is 12,000, so we're left with 53. That goes back into the investment account, goes back to the 1.747, and it turns out that 0.72% that they're earning on the remainder of the 1.8 plus what's reinvested ends up being more than where they started. So this is called capital preservation. We can see that the 1.8 million remains level. Slight growth here. I could probably go down to 0.715 and it would stay closer to 1.80 throughout the entirety of retirement. But 0.72 is pretty close. What does that mean? That means that if they simply achieve less than 1%, between 0.72 and 1%, anything equal to or greater than 0.72%, that they will have, that their kids will inherit the same $1.8 million that they started with after they pay tax on their RMD. Now, what if we did something a little better? What if we were to earn, say, 3%? Right now, there are fixed rates paying, on a 3-year, and this is in California as of August 9th, 2022, 3.5% you can get on a 3-year, and you can do 4.1 on a 4-year, which is phenomenal. Rates are really good right now. How does that end up looking for their portfolio? Well, that ends up looking really good. And not only do they have capital preservation, they actually have capital appreciation at very little risk. We have to be careful about using the word guaranteed because even though the product is called MIGA, for instance, it's a multi-year guarantee annuity. That if the company were to go insolvent, well, then there wasn't really a guarantee. The likeliness of that happening is very low. And a lot of these companies there's insurance called Caliga that's tied to these type of products, similar to what you might find at the bank, FDIC. But it's a fixed rate. And when I say guarantee, what I mean is you don't have to worry about the ups and downs of the market, that they're going to pay you the 3.5%, whatever the fixed rate is, compounding annually for whatever the duration is, in this case, 3 years. So if we were to assume they could get that 3.5% rate fixed rate through all of the years of retirement, then they'd have capital appreciation. The monies would actually grow, and their kids would end up with more than the 1.8 million that they started with.